ADR, leverage, and finding your time frame. ADR equals the average daily range. ADR is a common indicator on most platforms, and it expresses volatility or range over for a specific period of time and over a certain number of candlesticks. Not just for the daily time frame, but for any potential time frame you wish to trade. So volatility is the lifeblood of a trader because volatility equals potential opportunity, right? Without movement of an asset, there's nothing to take advantage of. So we use an average to help smooth out the daily jumps, and as a bonus, a trend will emerge from the data. We can see if volatility is trending higher or lower. And the combination of the range you identify, the potential leverage you can apply to the asset, and your account size will all play into what you trade and how you trade it. So ADR in action. Notice ADR in the lower pane down here. These things may change daily, but this gives us a very good idea of the window of opportunity at any moment in time, right? So this is the price action up here, and then this is the corresponding ADR, right? So I think this usually has, I usually put on like a period of 10 or 14 periods to smooth things out to get this trend, so it lags it a little bit. But what this shows us is that we can see here where daily volatility is contracting, right? And you can kind of see it here. There's just not a whole lot of opportunity here because the price isn't really going anywhere. Volume will generally creep up, not during the smooth trends, but when the trends start to accelerate, and specifically when the trends reverse. So anyways, just the idea behind this is that it gives you at least a base point to pay attention to, right? So this is an Ethereum chart, and so this is going to give you a number. You know, when you click on it, it's going to give you a number. Be like, all right, based on the last 10 days, Ethereum's traded about has about $150 range during each day, you know, during these flat periods. You go, okay, so if it has an $150 average, well, it kind of becomes easy, or at least easier, to pick out profit targets, right? Meaningful profit targets. Not just being like, man, I'd love to make $1,000 on Ethereum today. Like, no, we look at the ADR and it shows us that, no, yeah, you have about, you know, for the most part, barring some crazy news or volume coming into the market, it's going to move on average about 150 a day, probably give or take $25, right? So we know that once we've hit kind of the bottom of the range, or once we've hit about $150 worth of range, the market's probably not going to go that much farther. So if it happens first thing in the morning, it might be a good idea to consider reversing for the day. The price is probably going to check out the other side of the range, or it's just going to float in the middle. But if you're during your time period and things start to trend and it's only been going, you know, it's only up $50 on the day, well, you know that there's a good chance that it could go for a run for another 100, right? So knowing that puts something very potentially powerful at your fingertips to say, okay, well, I should set my long-term, my farthest target out $100. And so instead of taking another $25 or $50 and just guessing as to where your profit target should be, things become much more meaningful when you can use previous information the market's given you to make meaningful decisions for your trading currently and for the future, right? So anyways, and then obviously it goes up, comes down. So even though it's extended here, it's coming down because the average is not what it was in here, right? But we still know it's elevated, so you can still use that, right? We see up here that it got up to 700, right? On average, like 700 a trading session 2 months from where it was doing 150. It's crazy. But knowing this arms you to be able to use that information in a powerful way. So when will you trade? So this boils down to personal choice, and we are all at different stages in our lives with different obligations. And the cool thing about trading and what I'm teaching is that this is applicable from day trading to long-term investing, any time frame you desire. And that also is another key indicator of whether or not your ideas will actually work, and over a long time frame is they should work on any time frame, right? So what works on the daily time frame should work on the minute time frame, And what works on the 5-minute time frame should work on the weekly time frame, right? They should all be kind of interchangeable as far as how you apply what you're working on and the things. It should the only thing that should change is the time frame of how long that time frame is that you're looking for that certain result, right? So as much as most of us would like to day trade our way to millions, the data shows that this is extremely unlikely to happen. Full-time trading is a very disciplined and high-performance endeavor. It's totally doable. You just must be willing to work for it, and you need to know what you're doing. Most importantly, this is something that you can improve at over your entire lifetime. The more often you trade, the more experience you will gain in a shorter period. But if you are not taught how to analyze and break down your trades in a meaningful way, then unfortunately, the most important bits you can pull from each trade are lost. This is just spinning your wheels and where most months and years are lost. All right, leverage. So what is leverage? Leverage in financial markets specifically relates to how much of an asset you can trade with the funds available in your account. All right, so different asset classes can provide different levels and forms of leverage. Traditionally, if you had $100 in your account, you could only buy $100 worth of stock, but not anymore. A margin account will effectively give you a 50% increase in your account balance. So if you deposit $1,000, you can now trade with $1,500. So that's neat, right? But you must be careful because leverage increases profit at an accelerated rate, but it also does the same thing with your losses. When you're not profitable, you want to keep leverage as low as possible until you have proven that your strategy and execution are profitable. Continued. So futures. This market mainly consists of commodities. Okay, sorry, I said that wrong. The market mainly consisted of commodities in the beginning, but has expanded to stock indexes, currencies, crypto, and the list goes on. They also have the highest leverage at 90 to 95%, which means that for $250 to $500, you can control $5,000 worth of an asset. You can see how things can quickly get out of control here, not in a good way. So the Forex markets, that's foreign exchange, relates directly to currency, which trades on an open market just like everything else and has its own leverage of 50 to 1. In Forex, you can adjust your leverage by reducing the amount you trade, which is really cool. Now in stock options, they allow you to control 100 shares of stock with one contract. There's a lot more that goes into stock options, and even though we won't be going out in the course, it's quite a neat tool. There's just a lot of nuances and stuff that go with your strike prices and with the expiration dates and all that stuff. But again, it's a lot simpler. The understanding of that is a lot simpler in reality than people make it out to be. It can be very intimidating. As you can see, there are various exciting options that allow you to extract more money from markets than traditionally just buying and selling stocks, one-to-one. Though this should be saved for when you become profitable. When you hear of a company or individual blowing up in financial markets, it is almost always because of leverage. So that's just a warning to be careful.